Okay, that's our cue. We're going to go ahead and start up. Good afternoon, everyone. My name is Gary Kowalski. I'm the Director of Sales for the Entrust Group. And thank you very much for joining us on today's webinar, in which we'll go over an introduction to self-directed IRAs, and our special guest, Chuck Tralka with GCA Equity Partners, will be kind of making a comparison. He'll be giving a background on and speaking about private lending and pooled funds with regard to real estate. So to begin, we're just going to give a little bit of a background on Entrust and GCA, and then we'll walk through the agenda and really kind of officially kick off at that point. So who is the Entrust Group? We are one of the nation's leading administrators of self-directed retirement plans. And we've been doing this for about 32 years. We have a little bit over $4 billion in client assets under administration. And probably the things that are most important to understand about Entrust are in the bullet points near the bottom there. One, Entrust is very focused on educating our clients and prospective clients. We'll provide in-person programs in our offices or webinars like this that try to present folks with investment ideas that perhaps they were unfamiliar with or simply wanted to learn more about and speak with people who know a little bit more about those. We also have a national CE program for professionals. Second thing that differentiates us from most of the firms in the business is our local office and designated representative model. Typical to this industry is when you're looking at self-directed investing, you'll call up a company, they have an 800 number. Transactions take time, they take many conversations. Each time you call in, you usually get a different person and oftentimes have to begin from scratch. The Entrust model tries to be a little bit different. We have offices in every time zone and a designated rep for you to work with start to finish, from the account opening process, through funding your account, walking through the transaction, all the way to the post-purchase phase. So they get to know you and vice versa, and really try to shepherd you and your account through the whole tenure, if you will. And I mentioned our special guest, Chuck Tralka. Chuck is the fund manager for GCA Equity Partners, which has a private real estate fund. Chuck's been investing in primarily residential real estate for more than 20 years with a heavy focus on single-family residential as well as through private lending. Chuck's also got a very interesting background as a former high-tech executive for many years in some very prestigious companies, and his contact information is there. And Chuck will be leading the bulk of the presentation on the real estate portion, and then we'll move along to questions at the end. So before we begin the formal portion, I just need to inform everyone that the Entrust Group does not provide investment advice, nor do we endorse any products or specific service providers. As I mentioned initially, we work to try to educate our clients, present new ideas and the like, but whenever you're considering any type of an investment, we would strongly encourage work with a professional, whether it's accountant or an accountant or a CPA, financial advisor or attorney, what have you. Do your due diligence. There's a lot to it, and we really just provide the educational and administrative aspects. So looking at today's agenda, we've already covered the welcome and the introductions. I'm going to spend probably about 10 minutes giving a little bit of background on self-directed IRAs, the basics, their advantages, and some of the options within them. Lots of people that dial into our webinars have very limited or little, if any, familiarity with self-direction. So I'm just going to kind of provide a broad stroke of that. And of course, questions can be asked at the end, or you can always dial us at the number at the bottom of the screen for more information. After I go through that, I'll hand the baton to Chuck. Chuck will walk through some of the basics on traditional real estate investing, and then get into the bulk of the presentation looking at both private lending and pooled fund arrangements in terms of what they are, the pros and cons, things you need to think about when considering those types of investments. He'll walk through kind of a basic example, and then we'll move along to Q&A. One of the funny things about the Internal Revenue Code, which really oversees the regulations, if you will, of IRAs, is that it doesn't always say what you can do. It sometimes will say what you cannot do. And then by default, if it doesn't say that you can't do it, you can, if that makes any sense. So I want to actually walk through here what a self-directed IRA is and what you cannot invest in, and then we'll get into what you can invest in. So self-directed is really an industry term. All IRAs are the same, governed by the same Internal Revenue Code sections. Self-directed is a little bit different in that it's an IRA where you invest in non-traditional assets, or assets not typically traded on public securities markets. So things such as real estate, precious metals, private stock. Those are probably our most common investments, along with promissory notes. You can lend money out of your IRA. If you go to the large banks and brokers, typically they won't inform you about those, and they won't allow you to do those with those firms, because those are simply not products that they offer. But they're perfectly permissible, and for certain folks, they make a lot of sense. So we'll get through a list momentarily of some of the things you can invest in, but again, I want to touch on what you cannot. So the list in the Internal Revenue Code is very short. Number one, collectibles. Collectibles are really a hobby more than an investment, or at least that's how the IRS deems them. So things such as fine art, baseball cards, stamps, coins, antiques, those kinds of things are not permissible as an IRA investment. Now you'll see on the screen there's an asterisk for metals and coins. Metals that meet certain purity requirements are absolutely permissible. And for those that have questions on those, we have a precious metals center that we can put you in touch with, and they can fill you in on all of the requirements and how those work. Second item that's not permissible is life insurance. You can't have your IRA purchase a life insurance contract on someone. The last one is S corporations. Your IRA cannot invest in an S corp. So it's a pretty short list, and frankly, you're really constrained more by your imagination and creativity than what the IRS promulgates. So we'll take a look now at just a quick sampling of some of the things that you can do with your IRA. So this webinar is focused primarily on real estate, so you'll see a number of those listed here. From a real estate perspective, there really are no limits. You can invest in residential, whether it's a condo, single family, multifamily. You can invest in commercial. Medical office buildings are common. You can invest in a property to rent out, or you can invest in land, just what we call land banking. People invest in agricultural land, foreign properties as well. We have a lot of clients that invest in Central and South America and then rent out the properties to folks. And those investments have their own nuances, but perfectly permissible and something we see on a regular basis. Some of the other types of things that we see, as I mentioned, precious metals, hedged funds, pooled funds, which Chuck will speak about. Private stock is very common, especially smaller or startup companies. Secured and unsecured loans, whether associated with real estate or not. Oil and gas ventures. I'll be doing a webinar in about a month talking about some of the types of investments you can do in oil and gas. So you can do almost anything. We have clients that invest in cattle, in race horses, as long as they're it's truly an investment and it's not a hobby, or they're not utilizing that horse or riding it, it's a legitimate, valid investment. We've had clients invest in ATM machines. So lots of different things that you can delve into. Very quickly, some of the advantages I tried to distill down to a short list here. I've made it down to 3. 1, self-directed IRAs allow you to really kind of make your own investment choices and take control of your account, in the sense that you can invest in what you know and understand. Many of us have investments in the public security markets. I certainly do, and there's a lot of good ways to invest there. But I'm no expert in public securities, but a lot of people who aren't maybe an expert in real estate or other types of investments that they can do in their IRAs. And they know and understand these, and they would like to do them. The big banks and brokers won't allow it. That's where Entrust can fit in. You can invest in things you know, do your own due diligence, have control over it, and most importantly, diversify your investment assets so that they're not solely focused on the securities markets. The other major advantage is the different tax benefits. Depending upon the type of IRA that you create, the contributions may be tax deductible. It depends on your income and, again, the type of IRA. But the earnings within the IRA will grow either tax deferred or, in the case of a Roth IRA, tax free. And so we're going to take a quick look at the different types of IRAs that you can establish with Entrust, and I'll elaborate on those points just a little bit. So most common for a client to invest through Entrust is to establish either a traditional or a Roth. Now, the traditional, again, the contributions may be tax deductible. You have to look at your own scenario. The earnings grow tax deferred. So if you're 40 years old, investing, your investments are making good money, the earnings stay in the account. They're not taxed until such time that you take your distributions, which may be at 60, 65, 70, or what have you. With a Roth, which is our next most common vehicle, the contributions are not tax deductible, but there are a couple of very specific and really compelling advantages. One, the earnings grow tax-free. So if you're, again, 40 years old, you're investing, the earnings continue to stay in the account, and you decide at 65, 25 years from now to take a distribution. That distribution will be tax-free. So not only will the earnings be tax-deferred, but you're leveraging those to continue to build your portfolio, and then when you take them out, you don't pay any tax whatsoever. The other thing that people oftentimes don't know about a Roth is that unlike the other types of IRAs, there's no required minimum distribution date. So with a traditional, once you hit age 70 and a half, you're required to take some portion of your IRA out or make some kind of a distribution. With a Roth, you never have to. You can hit 65, 70, 80 years old, and you can continue to build that nest egg for an indefinite period of time. The other types of accounts, we have small business and what I call specialized accounts. Within small business, we have a SEP, Simplified Employee Pension, a SIMPLE, which is a Savings Incentive Match Plan, and an Individual K, which is an individual 401k. The Simplified Employee Pension and the Indy K can fit certain people extremely well. The primary reason being you can contribute up to $51,000 annually into those accounts. And so it's a great way to set aside a large dollar amount into your retirement plan in a short amount of time. Now those again are for small business. The Indy K is restricted to an individual business or a business owned by an individual or an individual with their spouse or partner. And for more specifics on that, again, you can call the number at the bottom of the screen and we can speak with you, or we may be able to respond to some of your questions on this call. The simple plan is not one we see very often. That tends to be advantageous for a small business with a lot of low-wage employees. Regarding the specialized accounts, the ESA and HSA, an ESA is an account where you contribute funds that are, the contributions are not tax deductible, but if they are taken out or the distributions are taken for qualified education expenses later on, they are tax-free. The health savings plan is similar, except the contributions that you make are tax deductible. And again, there are certain requirements that you need to meet in order to be eligible. But later on, if you take out the, or make a distribution, take out the proceeds, if those proceeds are used for qualified health expenses or medical expenses, those proceeds are tax-free. So that's kind of a quick overview of Entrust, of what we do, a little bit about what a self-directed retirement account is, how they work. There's a lot more to it, and we're happy to answer your questions, but I just wanted to give a broad brush stroke. Now we'll get into the meat of the discussion, and I'll hand it off to Chuck, and he's going to go into some of the traditional ways to invest in real estate. So Chuck, please take it away, and thank you very much for joining us today.
Okay, thanks, Gary. So I wanted to start by saying that I think there are a lot of different ways to invest in real estate, and there are what I call the traditional types of properties and traditional strategies that can range anywhere from single-family residence to apartment building to commercial property. And within each of those types of properties, you can, for example, buy the property to rent it out, buy it to fix and flip, or buy it, fix it up, and maybe hold it for a long period of time. And what the kind of property that you're working with and the particular strategy that you employ have to do with what your objectives are for that property, whether it's appreciation or income or some combination of the two. And what I'm going to focus on today is an income strategy for real estate investing that really is completely different from any of those types of kind of traditional real estate approaches. So let's take a look at a very highly simplified real estate transaction. Probably most of you have been involved, if you own your own home, as a buyer or seller of the property. If you're a real estate investor, you've probably also been involved as a buyer or a seller. But I'd like you to consider that typically, I would say in the vast majority of real estate transactions, there's a big third-party participant that's called the lender. And so together I call these the 3 R's of a real estate transaction: the buyer, the seller, and the lender. And what I would like everybody to consider on the call is that you can choose which one of these participants you want to be. And again, traditionally, you would participate as a buyer or seller, but there's really nothing to prevent you from becoming the lender. And it's that lender approach that I'm going to talk about in the presentation today. So let's start with a definition of lending for real estate, and it's called private lending, which is opposed to, say, for example, traditional bank financing. But the definition is very straightforward. It's simply private investors like you and me making loans that are secured by real estate. So in this model, essentially the investor, you, becomes the bank. The fundamentals of the transaction are very straightforward. So you're going to lend money against a piece of property that a borrower is going to pledge as collateral for that loan. They're going to pay you interest for the term of the loan, and then at the end of the term, they're going to repay the principal, And when they do that, you're going to release the control of the collateral back to the borrower. So fundamental characteristics, you've got a loan amount, you've got a piece of property, you've got interest, you've got a principal repayment that can happen during the life of the loan or at the end of the loan, and then you've got collateral. And so it's a pretty straightforward model, at least at a conceptual level. Turns out the details are a little bit more involved, but we'll get into some of those. Okay, so there are two key documents in every transaction, and if you've bought or sold your own property or your own house, you're probably aware of these. Maybe not in the front of your mind, but you've probably seen or even signed these documents yourself. On the left-hand side, we've got the promissory note, and that's pretty straightforward. It defines the terms of the loan, so it lists things like the loan amount, the length of time that the loan is going to be active for, the interest rate, how payments are going to be managed, how the loan is going to be repaid ultimately, and fundamentally who the borrower is, who the lender is. On the right-hand side, we have the deed of trust. And at least this is the way it's done in California. It's a little bit different for other states, but the mechanics are very similar. And in the case of the deed of trust, that's the legal document that basically attaches the promissory note to the collateral that the borrower is pledging. So that's the way that the loan is secured. And that basic concept of securing the loan is really important because unlike a lot of other types of traditional investing, private lending and real estate in general has the advantage that there's a tangible asset that backs up your investment. And of course, it's important to have that whether you're the lender or the buyer in a property transaction. So I think there are a lot of legitimate ways to invest in real estate. I've done many of them myself, and probably many of you have as well. And I'm not here to say that private lending is better or worse than other methods of investing. But I would like to point out that there are some significant advantages, and here are some of the reasons why you might want to consider getting into private lending if it's something that you haven't done already. First of all, as I mentioned with a deed of trust, you've got the security of the property as collateral for the loan. And one thing to consider is the lender in a transaction is actually typically in a more secure position than a person buying a piece of property and making a down payment on that property. So that's something that's not obvious, but the lender typically has a very strong security position in the property, and of course that's important to protect your principal investment. Also, this type of investing can have a high degree of liquidity. For example, a lot of the kinds of loans that we're involved in, the loan terms range from 6 to 9 months, maybe as much as 12 months. But this is an advantage, of course, because if there's a major shift in the market, you've got a position that isn't tied up over a long period of time. So that lets you be reactive to the market conditions, which potentially could save you a lot of money if things are changing dramatically. You have another advantage that the transactions are transparent, and this is particularly important if you're going to invest through a pool, which I'll talk about later. But essentially, all of these transactions are part of a public record, and you can look them up through any of a number of sources. And so it's difficult unless you do something careless with your money. It's difficult for that money to just go somewhere else. It almost always will be going into the property, and you can actually see that as part of the public record. Another advantage of private lending, I mentioned, of all the different real estate strategies out there, some are good for investing in appreciation, kind of a long-term model. Others are good for generating income. And private lending in particular is a good income strategy. And in fact, the way that I got into it was thinking about, for my own retirement portfolio, how I was going to generate income from the set of assets that I've been accumulating for a long period of time. Also, you've got the potential for high yields. If you look at other alternative investment options for income, you'll find they're typically lower than the kind of returns that you can get with private lending. Let's see, so private lending also works for a very wide range of investment levels. Usually the smallest levels that we see are on the order of $25,000. But whether you've got $25,000 or $25 million, there's probably a private lending deal out there that would be a good fit for the level of investment that you're interested in making. And then finally, it works for a very broad range of property types, including single-family residences, apartments, commercial property, land development, rehab situations, or even new construction. And so regardless of the kind of style of property that you like to be involved with, you've got the potential to do that as a private lender. So there's a traditional model of private lending, and I think people that haven't been involved in it are surprised to find that there's a very well-established ecosystem of professionals. Most people are familiar with escrow and title companies through buying and selling their own property, but the basic mechanics are the same with private lending, except you participate as the bank, as the lender, rather than as the buyer or seller. And the model is well understood, well supported by a whole team of professionals like real estate brokers, loan servicing companies, attorneys. There's even dedicated software for loan servicing and even for fund servicing, which we'll get into in a little bit. So the model's been around for decades, probably even longer, but each state typically has its own set of rules. And I would say the California laws for private lending are particularly well developed. In fact, the state of California even has a publication called Trust Deed Investments. So trust deed investing is just another word for private lending. And actually, I recommend taking a look at this. You can find it on the web very easily by just Googling State of California Trust Deed Investing, and you'll find it pops right up off of the California, used to be Department of Real Estate, and just recently changed their name to the California Bureau of Real Estate. But in any case, I do recommend taking a look at this document. It's got a lot of good advice. So there are a lot of different styles of private lending, and what I've been talking about is really kind of a vanilla version. One variation on a theme is private lending with profit sharing, and so this one is interesting because it combines an income component with an appreciation component. And so it's very similar to the way that you would do any other private lending deal, except that part of the promissory note includes a provision to participate in the appreciation of the property. This is particularly common for a rehab scenario or possibly new construction, where it's very clear that there will be some appreciation in the property over the short term, and the lender, basically by making the loan, by enabling the project effectively, they're able to negotiate a position of equity share. And that can range anywhere from, could be as small as 10% and as much as 50% of the appreciation in the property. So you get this kind of nice combination of a regular income and then an equity profit sharing component at the end of the term of the loan. So a lot of people are curious how to find deals, and in California, you all of these private lending deals must be arranged through a licensed State of California Bureau of Real Estate licensed real estate broker. And you'll find, in fact, you can also Google your local area looking for brokers who, they'll call it either private lending or trust deed investing. And but if you look on the web, you'll be able to find those people fairly easily. So I recommend also talk to local real estate agents if you have an agent that you've been using. They often will know people who are involved in this business and maybe can recommend somebody for you. Another way to make contacts is attend local real estate investment meetings. So these are often called REIA or REI meetings. And if you Google that for your area, you'll find that there probably are already active monthly meetings going on with a lot of different real estate investors. And then finally, just network. Talk to as many people as you can, and make phone calls, ask questions. You'll find, I think, that if you've got money to invest, and in particular through a self-directed IRA, which we'll talk about in a few slides, you'll find that people are probably more than happy to talk to you as a potential investor. So what would you look for in a deal if you were to make a private lending investment? And the very first thing that I would have on my list is a good quality property in a good location. Now I've got an asterisk on that with a little note at the bottom that says if this loan is for a rehab, like maybe some of the profit sharing models that I talked about earlier, then really the good location probably matters more than the quality of the property. So something to consider. Also, most lenders will have maximum loan-to-value criteria. So this is the total loan amount over the property value. And in the case of a rehab or new construction, some lenders will lend against the future value of the property, but typically always with some kind of a maximum level of 65 to 70% loan-to-value. And that's because you want you and the broker to arrange the loan in a way that you've got what we call an equity cushion in case something goes wrong, say the property sells for a lower price than anticipated, or let's say in the case of a rehab, maybe the costs were higher than anticipated. You still want the project to protect the principal amount of your investment in that property. And I think if private lending is done correctly, with the exception probably of the major market crash we had a few years ago, it's actually quite unusual for people to lose principal, the principal amount of their investment. So another thing to look for is borrower experience. So, does your borrower know what they're doing? Are they buying a property that they're familiar with, or a class of property that they have experience with? And also, what's their credit worthiness? So in most cases, borrowers will fill out what's called a 1003 loan application, and you'll also run a credit check on those borrowers to confirm that they're likely to repay the loan that you're going to make to them. Another thing that I look for in a property, especially ones where we're doing relatively short-term loans, we want a clear and plausible exit strategy. So we want the borrower to be able to tell us exactly what the plan is for repaying our loan, how they're going to do that, what the mechanics are, when it's going to happen, and how they're going to achieve that. And it's got to be plausible. They've got a plan to, if they're going to resell a property, for example, they've got to plan to resell it for a price that's reasonable given the local market conditions and the type of property that they're borrowing against. And then the very last thing on my list, although it would be on my list, is a reasonable rate of return. So you've got to make sure that people are, that you're going to go through all this work and you're going to get some reasonable return at the end. But I actually wouldn't worry about that until I made sure that all those other items on the checklist were addressed first. So at the beginning of the presentation, Gary talked about how you can use a self-directed IRA for investing in a number of types of investments, including real estate. And it turns out you can use it for private lending as well. The way you would do that on an individual deal, of course, the very first thing is you want to set up your self-directed IRA account with a custodian such as Entrust. Then the account has to be funded, so there's got to be money in the account before you can do anything with it. You want then to identify the deal, and you're going to commit a dollar amount. Maybe you're going to do the entire deal, or maybe you're going to participate with other investors, but the broker is going to want to know how much money you're going to invest, so you'll tell them. Then they'll work with you, you'll work with them and your IRA custodian to fill out and submit the appropriate form and deal paperwork. It varies a little bit from custodian to custodian, but all of them, including Entrust, are very good about having their information on their website. You can download it, fill out the forms, and you want to have that stuff ready as quickly as possible because you'll find private lending deals tend to move very quickly. Some deals are funded from start to finish in as little as 1 week, but I would say a very typical time frame is 2 or 3 weeks, which is just barely enough time for you to get all the appropriate paperwork done, submitted to the IRA custodian, and have them have time to review it, approve the transaction, and wire the funds. And then the last step is for the custodian they'll send either a check or a wire, depending on what you request, into an escrow account. And so one thing I tell people who do private lending, you almost always want to be wiring your money to the escrow company who's handling the closing, or some lenders will use a sub-escrow account to accumulate the money and then wire that collectively into the closing escrow. It would be very unusual, and I would probably ask a lot of questions if a broker or other lender asked you to wire money to them directly. So just one thing for you to watch out for. And of course, wires can happen more quickly than checks, but usually they're a little bit more expensive. So all of those things are things to consider. Okay, so there are 3 possible ways to invest in a private lending deal, and to keep them simple, I call them one-to-one, many-to-one, or a fund, which is a many-to-many model. And by the nomenclature, I mean just the number of investors versus the number of properties that are involved. So you can have a single investor who's entirely funding the loan on a single property. That's actually the simplest model. You can have multiple investors investing in what are called fractional notes, and so their multiple investors together are funding the entire amount of loan for a single property. Or you can have, on the right-hand side, we're showing the many-to-many model. So that basically means you've got multiple investors, multiple properties, and the money actually goes into a pool, and that's why Gary referred to at the beginning pooled funds. Basically, that means that all the investors' money is going into a single pool, and it's the pool itself that owns the portfolio of loans. So no single investor is associated with any particular property, but rather the investors are associated with the pool, and the pool owns the entire portfolio. So everybody's automatically diversified in that scenario. And there are pluses and minuses of both. So on the left-hand side, I've got pros and cons of the one-to-one or many-to-one model. And on the right-hand side, I've got the pros and cons of the mortgage pool, also called the fund model. And they're actually fairly similar in terms of rate of return, security of loans, efficiency of capital. But the 2 areas that I've highlighted at the bottom, that are really the big differences between the two: evaluation of deals and diversification of capital. So, and again, I'm not saying that one model is better than the other, but in the one-to-one model for deal evaluation or the many-to-one, the individual investor really has the responsibility of choosing where their money is going to go and picking the deal. So the broker will present the deal, but they won't really take responsibility for making the decision. That's up to the individual investor. Whereas with a mortgage pool, there's a professional manager who makes that decision, and they have the responsibility to make, ideally, good decisions on behalf of the investors. But so you could consider that an upside or a downside depending on the level of control that you like to have as an individual investor. And then for diversification of capital, of course, on a one-to-one deal, there's no diversification. That investor's money is going into a single property. But investors do have the potential to maybe reduce the amount. Let's say they've got $100,000. They could, rather than putting $100,000 into a particular property, they could divide that up into, let's say, 4 pieces of $25,000 a piece and put those in as fractional loans on a number of properties. So it is possible to get a degree of diversification. But if you took, for example, that same $100,000 and put it into a mortgage pool, then that money may be used to fund loans for 10 properties or 20 properties or 50 properties. So, so the level of diversification is almost always higher with a mortgage pool than it is with individual deals. Okay, so if you're considering investing in a fund, there's kind of another layer of decisions that you have to make. And once you make those, then basically the fund manager is going to start to make decisions on your behalf. So, but this would be the list that I would consider if I were looking at a potential fund investment. First of all, I would look for experienced managers, people who've been doing this for a while. And secondly, who have a very solid track record. And I would really look at both yield, so that, you know, what kind of a return have they been providing for their investors. But I would also look at safety of principal. So have these guys ever lost any of their investors' money? And I would probably even do a little web research to find out if I could, you know, dig up anything that maybe they're not telling me. Number 3 on my list would be appropriate licenses and permits, and it really depends on what kind of entity they've set up. There could be a federal PPM, or it could be a state registered offering. In the case of our fund, just by way of example, we're required to have a permit from the California Department of Corporations. The LLC that is used for the fund is registered with the Secretary of State, and then we're required to have a licensed broker of record from the California State Department. What used to be the Department of Real Estate just changed to Bureau of Real Estate. Number 4 on my list would be prudent underwriting criteria. So I would ask them what kinds of criteria do they have for the loans that they're making. And then number 5 would be a system of checks and balances in the form of third-party accounting. So my preference is to see a third-party CPA in the picture. Also, I prefer to have a third-party loan and fund servicing company, and also annual audits that are done also by an external entity. So when you're handing your money over to a fund, you're really trusting those people to manage your money effectively. And I think that's more likely when that fund manager has intentionally set up a system of third-party checks and balances. Okay, so if you're considering investing in a fund, there are some other requirements, and they can vary depending on the type of fund. The California state offerings are required, have a requirement of a net worth of $1 million, and that's exclusive of home furnishings and autos, or an annual income of $200,000 for an individual or $300,000 for a couple. Federal offerings, some of them can have provisions for what are called sophisticated investors that reduce those net worth or income requirements. And there's been a lot of legislative changes recently around private placements, and it's possible that some of those rules will be modified, but for now, a lot of the federal offerings still have those exclusions. So if you can show that you have experience in this area as an investor, then you may qualify under the sophisticated rule without having to meet the net worth or income requirements. Also, for the state-registered funds, there are typically requirements for state residency, and there may be limitations on the total percentage of your net worth that you can invest as well. Now, it is possible to invest in a pooled fund through your IRA if you have it with a self-directed custodian like Entrust. And the process here is pretty similar. You're going to set up the account, fund it, identify what fund you want to put your money into, and commit the dollar amount. And then the fund manager or their investor relations person would work with you and the IRA company to make sure that all the appropriate paperwork is submitted. And then the custodian will send a check or wire directly to the fund. And I will say, based on my experience with private lending, both individual deals and fund investments, that most of our investors who are investing through a self-directed IRA choose to go with a fund just because you don't have the same kind of tight timing requirements that you might have for funding a private deal. So with the fund, typically you can put your money in at any time, whereas with a private deal, there's an imminent closing, and you have to get your money in before that deal can close. And so you've got, again, you can have pretty tight deadlines that you need to work under. So one of the reasons, though, why a self-directed IRA is so nice for private lending, whether you're doing a private deal or investing in a fund, is that the income that you earn is classified as interest income, which is taxed as ordinary income. And for example, with a fund, if you're investing cash and you get a distribution, you're going, or even if you don't take the distribution, if you, let's say you're compounding your returns, but you are earning money every month or every quarter, you will owe taxes on that money if you've invested cash. Whereas if you've invested through a self-directed IRA, you can let your money accumulate in the fund without having any kind of immediate tax obligation, just as Gary was talking about earlier. And if it's a Roth IRA, then you may have no long-term tax consequences at all. And again, everybody should consult with their respective financial advisors or CPAs to look at the details of those decisions. So for people who are interested in learning more about this process, we do have a private lending white paper that's available from us. You can call us or email or sign up through our website. We'd be happy to send you a copy. And also anybody who's interested in a phone consultation, or if you're located anywhere in the Bay Area and would be interested in coming to our office in Campbell in the South Bay, we'd be happy to talk to you in person and answer any questions you have that way. And with that, I'll open up the attendees to questions. If you could submit them through the chat box, please, and I'll read them off and answer any questions that anybody might have.
Chuck, I just want to say a couple of things while we're looking for some questions to come in. One, thank you very much. That was a very, very nice overview that you provided, I think, and at a really wonderful pace. And at the risk of asking for the continued patience of participants, I'd like to just really quickly go back and underscore some of the bullet points you had on one of the slides, if you don't mind.
Yeah, go ahead.
On the slide that you put together, some of the things to look for in a fund, I just wanted to reiterate some of these because I thought I really liked what you put together here in terms of looking at who the manager is, their experience, their background, what is their track record, and I love that you included not just yield, but safety of principle, and what have they done over the years. I also very much liked examining the licenses and permits, because we see a lot of clients who don't necessarily take those steps, and because we are an administrator, we cannot provide investment advice. We end up saying, do your due diligence, but we can't tell them what to do. And sometimes we see clients make what we deem poor decisions in a sense. But I think this is great that that you included that, because I think that is a very important step. All of them are. The one other one that I want to underscore is point 5, whether it's examining their and then authenticating their financial statements, contacting their accountants or CPA firm, or viewing their audit details and things. I really like those. I wanted to mention them and thank you for incorporating them because I thought they were very, very important.
Good. Thank you, Gary.
You're welcome.
So we do have a couple of questions coming in. I see some of them I think are really for me and some are for Gary. So maybe let's start. I think this one's for me. This is from Deborah, and she's asking, what about the equity sharing aspect of a deal? Is that considered capital gains? That's an excellent question, and the answer is actually they're not. It's considered interest income. And the way the rules are written around a lender participating in equity sharing, the money that's collected as part of the equity share is actually classified as what's known as contingent interest. So it's really additional interest on the loan that's contingent on the profitability of the project. And so that's lumped together, and it's all categorized as interest income. Okay, and then the next question from Al. What options are there for those that have some IRA money but do not meet those asset income requirements you mentioned? So as I put on one of my slides, I think kind of a reasonable minimum is about $25,000. And I would say below that, it's probably just not worth spending the amount of time you would have to do on due diligence on a project to get involved. And many funds have a minimum also of either $25,000 or $50,000. So I guess my first objective would be to accumulate something like $25,000 as kind of a bottom baseline. Once you have that, then I think you could do either a private deal or certainly some number of funds would be available to you. And but the fund will have the disadvantage of having the income requirement. The state of California for private investors has just instituted a new rule where you have to fill out a form listing your, call it qualifications in terms of income and experience. But interestingly, they don't require you to meet any kind of threshold. You just simply have to fill out a form. So I would say a private lending deal is more accessible right now than a fund investment if you don't meet the income and income or net worth requirements required for investing in a fund. Okay, and then the next question is from Creed. And the question is, if you hold real estate in your IRA, do you need an appraisal each year by a third party? And so actually I can't answer that question except to say that for a loan portfolio, as far as I know, there's no appraisal required, but I don't know about holding actual property. And Gary, you may know the answer. I don't know.
Yeah, I can say, Creed, no, you don't need an appraisal each year by a third party. With Entrust, anyone who has an account with an asset in it, we will send you a fair market valuation form annually to request the valuation of whatever that asset is, if it's not something that we can secure from a public market. For instance, precious metals, we can go to the metals markets and value that quite easily. But we're not expecting a real estate investor to provide an appraisal each year. It would only be associated with a taxable event such as the sale of the property. So I hope that answers your question. It's not needed.
Okay. Thanks, Gary.
You're welcome.
And the next one is from Deborah. And it says, in California, what about SB 978? Limiting the percentage of our net worth we can invest in a trust deed, does it mean we can't limit more than 10% of our net worth? I think it means can't invest more than 10% of our net worth in a single trust deed or in trust deeds, period. So I'm going to answer this carefully because first I want to say I'm not a lawyer and I can't give legal advice. But my personal understanding of that law is that, and it's a relatively new bill that California just recently passed, is that it's 10% in any one investment opportunity. So, but again, that's my interpretation, and I would encourage anybody to consult their own legal advice if they want a more in-depth perspective. Okay, and the next question is from Mandy, and it says, if I take a non-recourse loan on a property in my IRA, do I need to pay UBTI? And then if so, does Entrust help me file it? I can answer from the, actually I can't answer this particular question. I think it's really not, it's more of an IRA question, and I don't know, Gary, if
yeah, I can tackle that, sure. And Mandy, it's a great question, and I'll give kind of an overview answer. If you have more specifics or follow-ups that don't come up in this immediate conversation, just send me an email or give me a call. My contact information is on the screen there. So first of all, UBTI, for those that don't know, is unrelated business taxable income. And it falls under a category of the Internal Revenue Code, UDFI, unrelated debt financed income. And that would be applicable to an IRA in a scenario where, let's say you invested in a $200,000 property and your IRA had $150,000 in it, and your IRA borrowed the additional $50,000 for the purchase. Now, the way it works, and again, this is just kind of a fundamental viewpoint, is let's say that scenario applies to you, Mandy. So $50,000 loan, $200K property held by your IRA. The $50K would represent 25% of the investment. So the bottom line income that your property generated, or whatever asset it might be, in a year, if it exceeded $1,000, I'm sorry, well, you would, let me take it from a more general perspective, and then I'll go into the specifics. The proportion of income attributable to the loan, in this case 25%, may be subject to UBTI. The threshold amount would be if that 25% amount exceeds $1,000 in a given year. So in this scenario, let's say you had $10,000 in income from that property, and that's, of course, after your expenses. 25% of that would be $2,500. Thus, that $2,500 would be subject to UBTI. If the scenario were you had $2,000 of income from the property, 25% of that would be $500. It doesn't meet that $1,000 threshold, and so you would not be subject to UBTI. I realize it's a bit of a mouthful, so I hope that makes some sense. In terms of your follow-up, does Entrust help me file it? We do not. That's up to you. And whenever anyone invests in through their IRA where their IRA has a non-recourse loan, we strongly suggest that you work with a CPA or an accountant to do the tracking and the tax work with you. For those that don't know, a non-recourse loan in the case of real estate would be a loan where the lender's only recourse would be the property itself, no other personal assets or no assets held in another IRA or anything like that. So again, I hope that makes sense. I'm going to spend a couple of minutes also going through additional questions that came through during the webinar that I texted responses to. So I'll try to go through these fairly quickly. If we don't get through all of them in the next few minutes, please contact Chuck or me directly. Again, the contact information is on the screen. So a few of the quick questions that came through. One, will these slides be made available to attendees? If you send me an email, and Chuck, as long as you're okay with it, yes, I can email out a copy of these slides to you.
Yeah, and I'm fine.
Okay, so anyone who would like that, just send me an email and I'll be happy to shoot those over to you. Somebody asked if we maintain a transcript of these and can we share that. We don't transcribe these webinars. However, what we do is we record them, and this one's being recorded, and within, I would say, 48 hours, it's downloadable on our website. And you go to the Learning Center and then events and things of that nature, and you should be able to find it. It's fairly intuitive. It should be up there by Friday. If you have any difficulty or you don't see it, again, send me an email, and I'll be happy to send you a link to it. The other question that came up was fees and how are they charged from an Entrust perspective. Anyone who likes or would like our fee disclosures on our website, I can email that to you as well. I'm going to give a quick overview of how that works for Entrust. So the typical process for somebody getting a self-directed IRA set up is step one, establish the account, as Chuck had mentioned. For us, that's a 2 to 3 business day process and a $50 application fee. Step 2 is to fund the account. Typically, people roll over or transfer funds from a 401k or a legacy 401k or an IRA held by a custodian such as Fidelity, Charles Schwab, Wells Fargo, etc. There's no charge from our end to transfer funds here. You fill out our form. We contact your custodian. We suggest that you also reach out to them and just let them know. The process can take a week or a month. Every custodian's a little different. With the phone call, typically it takes a week, maybe 2 weeks on average. Depending upon which asset type you're purchasing, if you're investing in something like a pooled fund, you direct us on what to invest. We charge $125 for real estate directly, or something like a pooled fund, it would be $95. There's also an annual asset fee. There are a couple of options that you have to choose from in that vein. Most people choose what we call it option 1, and it's $295 per year to administer that asset. The same fee that applied to purchase the asset would also apply upon its sale. That's a quick overview. I hope it makes sense. Additional questions, feel free to call us or fire me an email and I can send you our fee schedule, which again is on our website. Just click on Forms, General Fee Disclosure, and you'll find it there. And Chuck, I see there's another question here from Karen.
Yep.
If the funds for private lending are $100 IRA, why are what our personal income or net worth considered?
Yeah, I think the question relates to if the money's coming from an IRA account, why are there requirements for, it says 100% IRA. Why are personal income or net worth considered for participation? And the short answer is these are requirements that are put in place by either the state in the case of an intrastate offering or the federal government in the case of a federal private placement. And the fund managers really don't have any say in choosing those levels. In fact, the state of California recently increased theirs quite a bit to the levels that I showed in the slide. Previously, they were quite a bit lower. I believe that the thinking is that they're protecting people who don't have as much money to invest from putting it into a private placement, but that's just supposition on my part. Unfortunately, we don't have any say. We just have to follow the rules that are put in place by the state and the federal government.
I think that was a wonderful summary of it. And I'm not seeing any additional questions come through. Chuck, do you see anything on your end there?
Nope, I think looks like we're good.
Okay. We'll give it just a moment. And I see we're actually out of time here, so we'll have to wrap up. Our contact information, again, is on the screen. I want to thank all the participants for calling in and listening and for your great questions. And Chuck, thank you so much for a wonderful overview on private lending and pooled funds. And with that, I wish everyone a wonderful afternoon.
Thank you, Gary.
Thank you.
Thank you. Please stand by.